Okay, the next session is going to be a little bit of theory and some case studies, and case studies that may not answer all your questions, but we'll be around at the end of the conference after the last session to answer questions. But let's get started. And what we're going to do here is a little primer on how E.CLIPSE works, and then some situations, opening balances, WIP inventory tie-out, how we prove what's going on, how SAL WIP goes, and a fairly detailed, this is adjusting allocations of overhead, what you have to do that correctly. And then this is a fairly detailed case study on multiple payroll allocations, and get a sense of how to solve a problem. So just give you we're going to start off with the opening balances issue, and then see how that, and then understand how the allocations work. So a WIP opening balances is always an interesting situation when you get a new client get started, because most of them have a tax basis or market value inventory. So what they have on the balance sheet for inventories probably is not going to correspond with their actual costs are. So you've got to plug in something, and we always want to set a stake date, not have record all the opening balances as a certain date, which means you end up with short closeouts. You end up with some plugged assumptions if it's work in process for crops. But the stake date should always be the last day of the month. And if you're doing a January 1, you want a 12/31 as the opening balance date, because that allows you to put some purchases through and roll it through the income statement into the balance sheet into the next year. So it means short closeouts. If they do have WIP, even that is standard costing or incomplete. So let's say they have investment in growing crops on the balance sheet. Most likely that's probably fertilizer or seed. It's not machinery or labor or anything like that. So they're just keep in mind that starting a new system, you're going to have some beginning balances that are really using a different basis, and you're doing the best thing you can start with, but that's going to roll through the entire balance sheet and income statement until those products are sold, and then you'll new groups or fields that are started are going to be correct. So one of the questions is, when I getting an inventory in, do I run it through the GL, do a purchase through the GL, or I do it as a crop purchase? And it really could do it either way. It depends on what kind of balance sheet they've got, where they're coming from. But if I was do it through the balance sheet, I use a management or accrual entry, and then one of the mistakes made is I'm going to post that directly to a balance sheet account, an inventory account. That won't work, because that's with E.CLIPSE. We want to run it through the income statement as a purchase, and then the system will move it to the balance sheet. So it's basically you need to code it directly to the input, to the project, to the group, whatever it is. It's going to be a purchase to get it into inventory in the prior year or prior period. Any questions or observations on that? Everybody's done that? Understand what I'm talking about? To really understand how E.CLIPSE works, let's look at the different types of entries so we can understand it. Down here is a typical is your cash or tax entries. These are the E.CLIPSE assumption is you're going to buy inputs, run them through as an expense. E.CLIPSE is going to reverse that out, put it on the balance sheet as in the work in process. You're going to buy, if you buy a crop or harvest a crop, it's a purchase and an offsetting sale from the field, but it's we're not going to post directly to the balance sheet through the direct entries. What I'm showing here is for livestock, but it works perfectly the same for crops. So down here inputs, instead of feed, this is seed fertilizer and seed chemical fertilizer, and I have my direct costs, and I'm posting these expenses to a crop project or a group, and they start accumulating. And then what E.CLIPSE does is it makes, at the end of each accounting period, it reverses those out and goes through a WIP center that reverses out the expenses, moves it onto the balance sheet as accrued cost, work in process. So every month, if I run a cash basis report, I'm going to see these expenses down through the income statement. I run an accrual basis report, those expenses will be reversed and they'll be on the balance sheet. And then at the same time, I've got support operations costs, overhead costs that are being allocated, and they're set up by standard costing, and we'll look at some examples of how that works. So it's making these allocations as management entries. So I have cash entries, cash tax entries, accrual entries, and management entries. Management entries mean that they're entries that's handling internally. You don't want to gross up your cash reports, even though they're netting out. But they're being expensed, and then they're actually moving into work in process. So there's offsetting income or contra expense for the support operations going as an expense to the crop project or to the livestock location or group. But at the same time, we make another entry, accrual entry, that reverses that out, puts it on the balance sheet. So I've got the original expenses that are direct. I've got the original allocations for the support operations that are going through as income and expense entries, and then but those all get rolled into work in process accrual balances on the balance sheet. So work balance sheet. So I strike if I strike a cash balance sheet at the end of these periods, there won't be anything on the balance sheet because it's all gone through the income statement. I do accrual balance sheet, and this is assuming there's only one group or there's not other groups rolling through here, but they're just assuming there's one group. I do an accrual balance sheet, there'd be nothing on the income statement, it'll all be on the balance sheet. So that works until I start moving, either transferring that project, selling that project or group, and when that happens, we reverse out do an inventory adjustment to the accrual entries, and lo and behold, I have my original cash entries up here, the balances here. So we keep peeling off the balance sheet entries, and then I have my cost of sales comes through here. So the goal is I need to know at any one point in time, I need to know how much was from a prior stage, say a wean pig going into a nursery going into a finisher. I need to know those stage costs. I need to know all the expenses that occurred, whether they were direct or indirect, and I want to know that. I want to know that on the balance sheet, and I want to know it on the income statement. I want to know it all the way through the flow through here. So when I do an income statement, an accrual income statement, I will know exactly how much we really spent by account, how much of those different expenses matched up with that product,
Are you making a balance sheet at the end of each month?
Yeah, every month, right?
Huh?
Right. Yeah, balance sheet every month, not the middle of the month, because not the middle of the month. I can't do one every day because we're only doing the WIP adjustments at the end of the month.
But you are making one a month.
1 month, yeah, right. From a accrual standpoint, all this is happening behind the scenes. There's nothing, but just knowing what's going on. These are WIP entries. WIP centers that parallel the production centers, and we'll look at some examples of that. These are consolidating centers or support operations centers that are being allocated into work in process. Any questions so far? You can see examples. So this is what's happening behind the scenes. Now, one of the questions was we did a survey among MASA members, and they would like to have more automation, which would be great. Which when you create a production center, it says you want to create a WIP center, and it does that for you. But you got to remember that's why it's doing. And there's some setup and allocations, and I'll show some examples of how that happens. But just keep in mind, from a producer standpoint, I'm expensing everything. System does the accrual adjustments. I don't have to think in terms of whether I'm adjusting balance sheet accounts. The system does that for me. So and then give me all the management details the producers want to see. Yep.
So when I be working in FBS, I don't really ever think about or know about that I'm using E.CLIPSE or Transaction Plus. Those are kind of codes.
Well, you know when you go, I want to value inventories. That drives the E.CLIPSE entries. But otherwise, you're running reports in Transaction Plus. Assuming you're using E.CLIPSE, you use accrual, it's going to pick up the E.CLIPSE entries. Do cash tax, there'll be nothing from E.CLIPSE.
So does a MASA user really care whether they're in E.CLIPSE or Transaction Plus or something? Just kind of business logic, business.
Right. If you got the whole system, it doesn't really make any difference. But you just got to know the process. Nothing happens with E.CLIPSE unless you calculate inventories. That triggers all these allocations, adjustments, and you go back and if that's not what you want, you go back and recalculate and regenerates the entries. So these are WIP center entries, and these are shadow account entries, and we have for each general classification we have it's basically the assignment account, the internal account to say I'm going to reduce costs, and it's actually a contra expense account. It isn't an income account, but it's moving costs from support operations into work in process. So, the best way to do this is let's look at a WIP inventory tie-out, and got some examples. What I have is a crop example, but it really applies to livestock as well. So just think about it. Very important to tie out, basically tying out inventories from the project, which is the field or the group, rolling that all the way up to the balance sheet and making sure everything flows correctly. So what's required? I've got to have physical inventories balanced, and I got to have applications recorded. In other words, I can't create a work in process balance sheet if nobody's recorded the crop, the planting, and the spraying and the fertilizer application. Can't do it. You might want to do it, but you can't do it. You got to have the detail recorded here. Once that's recorded, then we're good to go. We can start adjusting things. So physical inventory is balanced. If you're negative, you got stuff isn't tied out. Nothing else is going to tie it out, but you're going to see how all that's affected. So then we run the inventory valuation, which is part that we're talking about. You need to trigger. And so if you do that, and there's no variances in the current detail report, and review history equals the Transaction Plus account amounts, then we know that ties out. Then we go to WIP inventory change report, and should match the WIP centers. So we'll look at these things and show you how that works. And again, remember this we're using a crop example, but this works same way in with the livestock clips. Okay, so let's walk through the process of tying things out. So we're going to use a crop inventory report and tell a recap by project. So the first thing, this is to make sure my physical inventories are correct and tied out. So in this example, I'm on a crop inventory report, pick the center I want to look at, and then I look at reconcile the physical inventories, and we're starting with 127,113 dry bushels. That's a combination of there's actually 5,000 contracted, but we don't use contract as a we don't use that treat that any differently than a physical bushel. So we're starting at 127,000 bushels. We don't know what the cost is yet. We're going to find that out, but that's our number to start with. So crop inventory valuation, the piece we're talking about, calculating inventories, is under setup, feeding or crops, and inventory valuation. And so we've calculated for that period. We click on the View History button. I can pick a range or individual centers. And I go down here, and here's our remaining units, 127,113 for this particular project. So inside the system, if your crops, they're called projects. Project could be in this case is a marketing project. It could also be a production project, which is a work in process in the field. With livestock, they can either be locations, or most likely groups. For this example here, so we make sure the physical inventories tie out. This says now that of that 127,113, it's worth $585,000 is the cost. And here's the breakdowns on a per acre basis. Seed, chemical, fertilizer, fuel. So, and we're only looking at dry quantities on a crop center. Livestock is just head. So then I'm making sure that this TA plus ledger amount equals the same amount. And this is what's actually on the GL. So this is internally being posted by project or by group. This is what's on the balance sheet. Now, why would the ledger balance not match what's in the module? We say we need to do that. Why would it not match? Yep. Could be an opening balance. Somebody. It's a human created entry. Somebody put that in, and it goes back to our opening balance issue. Oftentimes, is that there's accountant's balance that made it. It's hit this center. The reason it showed up here, but it didn't hit a project. It's just a journal entry that's in there. So we want to make sure that ties out. Life is good. Then we go to the WIP inventory change report. Now, WIP inventory change report rolls up to the center. So we've been looking back here. This is the project. Projects roll up to centers, or groups roll up to centers. So here we're seeing there's our 127,113 bushels at 585,000. It comes to as of 12/31 of 481 a bushel, 451 a bushel. And so, again, life is good. Everything ties out. And then I see all the other center totals, and there's center total for this is marketing centers, finished goods for crops, 1,086,000. Okay, so now let's run the balance sheet. Now, the balance sheet is only going to tell me the totals by ledger account. So I've got the detail of the WIP inventory change report for the center totals. I've got the detail that supports the WIP inventory change report under the project totals. So here's our inventory, WIP inventory, production crop, what they call it, 1,066,000. So we verify if there's a variance. As Daryl says, it's attributable to external or non-system generated transactions. And normally you're going to journal those after you don't balance, you journal them out for the Nest Center. If it's an opening balance, it's just a matter of adjusting that opening balance to make sure they're not double counting anything. So now that's finished goods. You only had time you have finished goods in a production operation is with crops, harvested crops, stored. You technically have finished goods with livestock, but they're on the truck going to market. So here's something that doesn't happen within livestock, but does happen with crops. Here's a crop operation, and we're going to go look at a more extended example here, but just to understand how that works. So this is part of our case study. So I have a crop operation that was recorded as a field operation, and field operation, this is the 924 sprayer, and 924 sprayer rolls up to a consolidating center called 79 for sprayers. So this operation has several sprayers, and they're all going to be charged off the same rate, but they want to keep track of usage by individual sprayer, and they're capturing that level of detail. So that rolls up here. I have that connected with a consolidating center. So consolidating center we use that for support operations. So this is an field operation. What's recorded physically in the field, consolidating center is how it's moved to on the balance sheet. Here's our sprayer set up, and again, this is the setup is a bear. These are our shadow accounts. So for anything for sprayers, we use an account called SA79. There's nothing magical about being alphanumeric. It's just a way of segregating it and telling us this is entered would be entered by the system. And then, so this is basically a permanent setup until if you add a new activity category, you need to go in here and set this up, but normally there's nothing to do once you got this going, get set up. And the other thing that has to happen is that if it's any kind of consolidating center or any account that's going to hit a project or a group directly, you need to have it on the inventory valuation expense line. You need to have that listed here on this expense line. So the rule is if it's going to go through WIP, that account has to be in this table right here. Again, this is just the setup, initially getting things started. You don't have to, unless you add something new, a new account, something else, you don't have to maintain this. This is going to happen, but if it's not, you're going to miss entries that go through WIP. So here we got all the categories, and you decide how you want to group this. This one they got shop and general crop and trucking, and they want to break things down so it matches the accounts or the shadow accounts back through the system. So everything starts back. It's recorded as a field operation. A field operation is accumulating hours and it's allocating sprayers, and so this is how things tie out on a field operation. Any questions on this? And we'll get into some of the actual examples here. Yes, Randy.
So you get individual sprayers rolling up. So this is S1, S2.
Right. Yeah. You have to be the. Yeah, I think that's the way you categorize it. And that's we're not identifying it as S1, S2, but it is right. There's a higher level. These are consolidating centers. These are service centers. No, sorry. This is not a service. This is an operation. So
you're setting up a unique operation for each sprayer?
Yeah.
So it's not an N1, N2 discussion.
No. It's right. They're just going directly to the consolidating centers. All right. So tying that out, we're going to a standard cost vendor monitor report, and in this, when we set things up, you've got a support operation, particularly crops. But let's so you pick a value. How am I going to charge it? What my basis is it going to be per hour, per acre, what per mile, what that is, and then what do you think that cost is? Because we got to start off with a standard cost because nobody knows what it is getting going, and the system will learn what that actually is. If you're contract finishing, you say, what's contract finishing per pig space, and you put that in, and it's generally pretty close to get started. So this one here, let's look at this. This is center in 79 sprayers, and under that, here are all the sprayers activities. So it's got 1, 2, 3, 4, 5, 6 sprayers, showing the cost of going into that sprayers. And they're not trying to charge a field based on that particular sprayer. It's a cumulative cost on a in this case on a per hour basis. So these are costs that have occurred, and most of them occurred. Well, I'm doing this through the middle of the year, so they show up Q1, Q2, and there's been expenses, depreciation and repairs and other things that happen, even though there was nothing not being used or in the shop being worked on. And then here's the allocations going out. So soybean production, corn production, and I'll talk about the regional setting here. But they've got regions that they realize the moving equipment. There's a cost to that they have to track, and so they're allocating that out. So we get down to the bottom. We're saying the hours, cost driver units, total 986 hours. And dividing the system has divided the cost by the hours and come up with $136.57 an hour is what the standard is. The actual actually came out to $151, and so we'll show you how to adjust it. But it's showing that the actual true cost of operating sprayers so far this year, which we're not complete yet, was $151 an hour average. So, yeah.
You're charging equipment out to the crowd field, not just on activity.
Go back to that screen.
Yeah, go back to that screen. This is the activity right here.
So,
And here's the fields going out here. So we're giving that. So these are the costs in, these are the costs out. So it is going to the fields, but it's going as that's pretty much an activity. Yeah, right. Yeah. Okay, so to tie out to see where that was actually occurred, we're actually giving the original transaction. So this is the import, and we'll show you example. We're importing this from granular. And here's 2.36 hours. This is a coming user defined report. So here's 239. Here's our charge, $326 center operation hours. So we're showing this is after the inventory valuation is calculated. This is showing right down to the field level. So, capturing the hours and charging things off. Now, okay, so now the other things we need to tie out. Well, this is on the project report. So now this time we're looking at individual fields, looking at the equipment allocation charge on a per acre basis. Now, equipment allocation includes everything. So we're not trying to. The choice is not to show on this report how much was spraying, how much it was harvesting or planting. Showing the cost there. You can see how that this is not through the whole year. It's not totally reconciled. We can kind of compare what Mo and John were showing earlier, what those costs are. And so that's going back to our setup on our expense bridge. We say one all these equipment allocations that we need to find. And now we get the WIP inventory change report that we looked at for the harvested crop. Here it is showing corn production units. There's 5,455 acres, and at 4489, excuse me, $797 an acre. They've got in work in process. And we've looked at the components here. I've got, this is 2019 corn. I've just taken a slice of that. There's a lot more projects over here, but they all add up to that $4.3 million work in process. So now here we're looking at a project report and just verifying project acres. And this we use a project report to get direct, just another way of getting direct costs, seed chemical fertilizer. Operations you have to go through the GL because they're being posted. There's no inputs being identified, or the operations aren't being identified in the price the same way in the crop program. So here's going to another detail. Here's inventory by project. It looks at each column represents the field of projects, and this we use to verify remaining or unharvested. So we looked at this on the marketing side. This is showing the acres of each field, the remaining units. The remaining units are the way we estimate how how we're going to peel off harvested costs. If it all was harvested on the same day, it'd be easy. If it's going over several days, we need to estimate what percentage costs are going to be pushed on the marketing centers. So here's our inventories. Here's our tie-out total inventory, work in process inventory for this particular center, and it matches the Transition Plus. So the marketing with inventory change report, here's the same values that show up on the with inventory change report. So the balance sheet, here's the 27,651 on the balance sheet. Now this is a different. Some of these are coming from a different operation, so but just to show you how everything ties out. And same thing with crop inputs. You gotta run the inventory report, physical inventory. The values on a crop inventory inputs, feed, drugs are going to be going to show you what the actual costs are. You set this for either first in, first out, or weighted average valuation. Shows the inventory 28,000 for seed. Here's the WIP inventory change report. There's our 28,000 broken down by each seed variety or chemical or fertilizer. So 28,000 here on the input inventory report, 28,000 here at WIP inventory, 28,000 on the balance sheet. So that's how you do a tie out on an inventory for crops and livestock. It'll be groups. It'll be feed categories. It works the same way. Any questions on the tie out? Yes. Yeah. And I want to get a livestock version on this too, but this one here.
Well, I think it's important to stress inventory.
You didn't add inventory the fifth time?
Well, I didn't. You have to make sure that when that inventory report is on the right-hand side of the inventory, that inventory is negative.
Guarantee it won't tie out. It'll be very frustrating. Alright, so I'll get to. Alright, so now let's get into a couple other examples here. And we've got some pork producers explained sow inventories. That's a little more nebulous. And when I say sow inventory, it's actually the pigs that were equivalent units that we're trying to adjust. So here's the requirements. I've got to have the months to average settings, and we'll show you what that looks like. I've got to complete this spreadsheet, or I just disconnect the PigChamp. If you've got a local copy, not a posted copy, we'll do the calculations. But I've got to get the spreadsheet put together. Again, if I got to if I'm setting things up, I got to set the stake date. And let's see, we've got a couple things that don't apply there. So here's what I'm talking about: months to average. So now, a growing crop, you're trying to guess how many bushels out there. As John says, you want to figure out what your divisor is, and divisor is acres, but you also want to know roughly how many bushels out there. With a gestating sow, you're trying to estimate how many pigs she's going to produce, and that's just as hard understanding how much of what your yield is going to be. So what we build some assumptions in here. Here is this may be familiar, Terry, but here's months to average, and that's the closest thing we can get to a gestating time period. We want to smooth out the flow of pigs. This is the gestating or feeding percent completion, and feeding would be in a continuous flow, and you're trying to estimate what the average animal there is completed, and we try to steer people away as much as possible from a continuous flow situation anyway, because with livestock it's very hard to make that work. But you have to do that with sows, the sow herd. So it's saying 50%, they're 50% completed, and that may be, if you're just doing a startup, that may not be 50% completed. But if you're a going business, you figure they're halfway along on average. And this is a pre-weaning percent, so it says the ones that are on the ground, that there's going to be 90% survival rate of the ones that are on the ground. So I'm going to say that there's 10 pigs, one of them is not going to make it, and I don't want to use that in my calculations. So this is an example of the spreadsheet, and basically what we're filling in is yellow. What's our change in gestating pigs, gestating sows, and lactating pigs. We're counting the best we can, and most sow record programs don't give you any kind of running inventory. You have to have some physical count. PigChamp does, and we're doing gestating presumed mated at the time when you do the inventory. So we're trying to reconstruct what we think was going on. And these are ones that are on the ground, and so we'll look at the calculations. And this is we convert to equivalent unit. Equivalent unit is a finished pig, a weaned pig, and so we're trying to boil it down to the lowest common denominator. Here, this is the inventory valuation current detail, and it said at the end of that time period there were 1,351 gestating sows. And the change in gestating units, I'm sorry, it wasn't 1351 gestating sows. It's 1351 halfway along. These are completed pigs, so that's 50%, and this one was set up for 97%. So there was a change of 319 pre-weaned pigs, back that down by 97%. It comes up to an inventory change of 366. So, and then it says there were beginning equivalent units of 10,648, equivalent unit change of 367, which is rounded up to 366. And then you got the average wean of 9.07. What is the average wean? That's trying to tell us the ones that are being gestating. Yeah, we know that they're halfway along. Well, how many pigs can we expect to wean from those sows? And so this is why this does not tie out from one month to the next, because you can put in that spreadsheet what your rolling weaning average is, and it's gonna jump around a little bit, but it's still much closer than what you'd otherwise. So it does a whip adjustment. In this case, it's a favorable whip adjustment because inventories went up. And here's this one here is the current detail. This is the history report looking at each month. Looking at the change. Here's the equivalent unit changes show up here at the top. This is the actual pigs that are weaned out that salvard. Not a two head is pretty minor, insignificant. You get these changes. Here's is at 367 increasing, and it shows making those adjustments. Here's the raw cost per weaned pig, and then we're taking the rolling average, a 4-month rolling average, trying to smooth that out. So we end up with this period we get to May, $38.24 for the weaned pigs. And all this is going to be on the website explaining how things are adjusted. But we're trying to estimate what's in inventory, what the changes are, and factoring it back by survivability, weaning average, what's going to happen, and try to explain it as clearly as possible in the reports. And it documents this. So that you could tie that back to that spreadsheet showing what your changes are. You're changing sow inventories, which has to be converted into pigs. 50% times of that times the weaning average. Any quick questions on this?
Well, you're just awful close to having a budget, aren't you?
Oh yeah. Well, this actually flows into the budget.
Huh?
This actually flows into the budget, but that's for another day. So here's the whip adjustment. These are actually from the GL entries showing those changes being made, and I've added some calculations just to document what's going on. But, so again, this is on the. We'll put this up on the website where you can adjust that. Now I want to get into the case study here because this is very interesting. But here's we talked about standard cost vendor model report. Just a tip on this. This shows you what's been allocated through overhead, and then whether things are matching or not. So if you run this set it up to run by quarter, even if you're only halfway through the year, run by quarter. So it's going to get 4 columns quarterly. And then if I want to end it as of the end of the year, then this button pops up here. It says view overhead allocation. And what we're looking at here's the actual cost, the standard cost. Skid loaders is $44, the standard cost is $165, so we knew that needs to be adjusted. Planters, $140 was the standard cost, $211 was $140 is the actual cost, $211 was the standard cost. And all that needs to be adjusted. So we do that. That pops up the screen right here. Here's a summary. Remember, here's our 79 sprayers. So that said, report value was 153, which says I'm going to, based on my actual costs in that time period divided by the hours, in this case, be by acres, what came to 153, but my setup value, my standard cost was 136. So if I click, these all default to yes. If I don't want it to change, I say no. And there's excavating equipment and so on. So if I do that, then I'll update my overhead allocation table. I'll recalculate it, and it resets everything so it matches zero variance. Takes those costs and charges things off. But you have to set it up this way for this screen to show up. So if you just do it, I want to do it for a month, it's not gonna show up. So of course, this for crops is trying to do an annualized estimate, which is pretty tough until you harvest the crop and roll things through. On a livestock situation where you're every month is the same activities, it would be much. You can do this much more frequently. So that's how you reset that. And it's basically called a virtuous cycle. So you're starting a new operation. Nobody knows for sure what it costs to do things. You take the custom rate charge. I always take custom rate charge, and I start that in, and we'll find out how close we are. Complete the year, you adjust everything back to what they actually is, and then you start the next year. Well, now you've got as Howard said, you got a budget. You know what your past year's cost, but your volume may change, your equipment mix may change. Something's going to change, and so you keep refining this. Adjust the cost drivers, allocate the costs, and move ahead. And you watch this. People who don't watch this, they got new, say a hog operation, put a new grower online, put a new, or you do something differently. You're not watching it. Those expenses are falling through the income statement. They're not being work in process. You're not watching things closely. So that's why you need to run this at least quarterly, not more frequently. Standard cost management reports. Make sure there's anything that's not hitting WIP. And when you get down, this is a multi-year results looking at what happens with WIP. This example broken down by the red is fuel. Excuse me. The red was labor. The blue is fuel, and the green is machine. And looking at those components, this one here has to be harvesting. This came from 4326 is what it was in 2017. It was 4196 in 2016, and I'm sorry, that was that's the standard 5337 and 2015. So you can run this report by standard cost management report by year too. So you can look at comparison between different components. Okay, so let's look at this example. This was a very challenging project, but something we did last year with a new client, very large operation, very diversified operation, and so they had direct production hours booked in granular. They were tracking hours in granular, and so direct production, we understand. You go out in the field, you got acres, you got rates, you have hours, and then they also have yeah.
When you say hours, that's tractor hours, time.
This was it could be clock hours because they had labor on there too, but it could be tracked. It's hours.
40 hours.
Yeah, it's employee hours. I think it's this one they were because they have equipment that wasn't running on an hour meter. Is that there were just these are clock hours. So, and they also do the same thing with maintenance hours, tracking that in granular. So they're working the shop, working on a piece of equipment, and they say I would assign that employee to that hour, but they're using a standard shop rate for them. So to make things complicated, and you can do a lot more if you're running Red Wing center point payroll, because you have another layer of allocations that you can do. You can assign, you can keep detail, but this one they're keeping all the employees were F centers. So there was a one-to-one. Otherwise, it's extra complicated. But the employee gross wages are recorded in Velocity, so they downloaded that. And at that point, all they know is Velocity. All it knows is it's going to this employee. So we're going to take everything else and allocate it. So they use a fixed rate for each employee for doing the service work, and to make life even more complicated, granular employee equipment codes were different from FBS. So be able to import that. So we want to charge employees fixed rates of the equipment, predefined shop rate, and each one had its own fixed rate. We want to charge remaining payroll costs to fields by employee based on actual hours in the field. So, and here's the whole layout here. So here's the Paylocity. So and this shows the center setup. These are the E centers. So we log payroll hours. granular, we're doing production entries, the field hours, and we're also doing equipment allocations. So granular says this employee is charged to this particular piece of equipment. So it's a journal entry from employee center to equipment center at a predefined standard rate for them. And then we end up, once they charge off, then I've got in the bucket, I've got the remaining employee payroll that's not charged to the equipment. So he may be getting paid $15 an hour, but he's charged in the shop, he's paying $25 an hour. So we pulled more dollars out from these hours. But then granular is telling me how many hours they're in the field. So it's matching up. So I need to pull those employee hours out and charge it to the field at the end of the day. So I've got a bunch of things going on flowing, and it's only 2 levels that we're looking at. It's this F center and the N center, and then going to the production center. So the unique thing about this is they were very, very conscientious about getting hours logged in the field and in the shop. That didn't happen by employee. This wouldn't work at all. And so here's the spreadsheet. Sarah put together a spreadsheet to map. Here's the equipment centers, matching them to the granular ID. So there's International 9370 is EQ 140, and FES is 140 in granular, and she did a lookup and converted that, and we do the import. Here's the AP entry that comes in with velocity. But here's the employees, raw numbers, and I'm sure with velocity is giving me quantities or not. It's not showing up in this transaction, but all the hours allocations are coming through in FBS anyway. So here's the employee totals for that period. Here's the shop hour imports. This is from granular, and we pulling in going from employee. Here's Brad. He's going to the 833 IH. The 100. It's 5.14 hours. Rate's 21.15. So here we're seeing the allocations. This is coming from employee 02 into equipment 193. And this is Daryl.
Was this creating performance in a spreadsheet?
Yeah, it's creating. Yeah, it has to create the offset, right? Yeah, and that's part of the mapping process to create that journal entry. Now we get production entries, employee equipment hours. Here these are hitting the centers. This is actually the direct operation charges. So we have the employee. And again, this is at the employee level, not at a support level. These employees are in centers; they aren't S centers, which is really unusual. It's normally you wouldn't get that level of detail. They're keeping track of. So here's their employee hours going here to equipment, and here with we developed a system. This is with granular, so we could pull and our normal input. We could pull in equipment hours and employee hours and have them segregated in 2 different columns and be able to match things up. So this entry is both the equipment and the employee, and it's getting pulled in. In this case, it's the same hours, but it has to be segregated one way or the other. So occasionally you have employees that aren't assigned to equipment. They're loading a truck or doing something that's running an auger or doing something that's so we're able to track that. So here's the field operation. Remember, running this through field operations crop audit and being the allocation from there. So here we're having the hours. This is crop history report, just doing searching for that. So here's on the field, tractors, heavy tillage, and we're keeping track of the hours for the equipment. And this is the field operations setup for for the employees. Again, they're one-to-one numbers here, and they're associated. The operation is, there's 25, and this is E25 to the center. And then here's the accumulated cost per single sprayer. We looked at this before. Here's a John Deere sprayer going across here and showing what the totals are. So we looked at that example earlier. So this is the detail on the individual sprayer, and showing the expenses that are associated with a sprayer, which is rolled up to another classification.
So they're keeping the labor and sprayer costs separate.
Mm-hmm. Yep. Oh yeah. It's a separate line item on labor. Is a separate line item on there. So here is the allocation table. Here's what's going into where planters are being allocated to. And as I said, they've got more complicated than just production centers because they have what they call regions. So the idea is that they're moving a equipment to a particular part of the distant operation area. They don't want to charge that to the first field to arrive to, because that really doesn't be distorted. It's to that region. And so we have a production center set up for the regions that we journal that out and allocate that out. So these are the regions. And then here's the employee, and this ended up charging at $14 an hour as the current charge to these particular centers. So I'll get sample reports. So this is a cost analysis by farm, and a cost analysis. The neat thing here is you can roll things together or include it. So here we're looking at farms or projects. This is 2018 projects. We can look at different categories here that we're charged to. And this is a preliminary report, but so it works in not the kind of thing I'd recommend for somebody who's never doing this, but somebody who is very, very number oriented. We ended up adding the capabilities of being able to import hours from a production import, and also this column mapping approach that we're using. So it works with anybody who has this information accumulated. This would have to be granular. Somebody else was doing labor hours and equipment hours to keep those things straight, pull them off. So this is what they wanted to do. This is constraints we had to work from, and remember from yesterday, there may be a lot of reasons that you don't want to go to this level of detail, but it is possible. It is possible. They can make decisions now by separating out the labor hours and the equipment hours, and dealing with the issue of people using their non-production time, being charged off, and giving that as an adjustment to their production labor. Any questions? So, when we conclude the session about 2:30 this afternoon, we'll be around if you got specific questions and work through some examples there.